We are Group 1, and our report is on the LBO transaction of First Data Corporation. Group 1 is composed of Cody Hyman, Jake Rogers, Danny Loveland, Jose G. Scaglioli, and Carl Schoen. First Data is a global technology and payment processing leader, serving more than 6 million merchant locations, thousands of card issuers, and millions of consumers worldwide.
These are three important years in First Data history. 1982, American Express did a spin-off, and First Data became a public traded company. The main causes was First Data was doing significant amount of business with MasterCard and Visa, who were main competitors with American Express. In 1995, the company merged with First Financial Management. The two companies combined market value of $13.6 billion, and in 2007, First Data announced their ownership by KKR. These are some general information about First Data in 2010. You can see $10 billion in revenue. They have business in 35 countries and serve customers in more than 80 countries. These are the business segments of First Data. You can see merchants, financial institutions, government, education, and corporate billers. The sources of revenue are generated by charging process fees, selling leasing devices, and fees receivable under contracts. The description of transaction in 2006, First Data announced the plan to separate from Western Union and did a spin-off. Rumors said that was laying the ground for a future merger or acquisition. April 2007, First Data announced that it had reached a deal with KKR. In July, shareholders approved the sale. In September, KKR announced it has acquired a company. The participants during the transaction were Citigroup, Credit Suisse, Deutsche Bank, Goldman Sachs, HSBC, Lehman Brothers, and Merrill Lynch. First Data expects to provide first preliminary stats for the credit markets since the mortgage crisis had changed the overall liquidity of financial markets. The rationale behind it: First Data is the leader company in the industry. Rick Dukes decided to retire in that year. Also, they had a good cash flow, and shareholders liked the idea of receiving a 35 cash option, which was a 26% premium when compared to the last closing price.
KKR's main goal is to increase the profitability and thereby the value of the companies it buys. And in large part, it does this by growing and building up companies. For KKR companies to reduce productivity, capacity, and forego growth and profit opportunity is senseless, says the George Roberts, co-founder of KKR. KKR is an American-based global private equity firm specializing in LBO transactions. The firm sponsors and manages private equity investment funds. Since its inception, the firm has completed over $400 billion in private equity transactions and was a pioneer in the leveraged finance industry. In March of 2010, KKR filed to list its shares on the New York Stock Exchange. The company divides its business into three segments: capital markets, principal activities, private and public markets. In the private market sector alone, KKR has added more than 60 companies to the portfolio, within 14 industries in over 19 countries. Within these three segments, the company focuses its investments on the following industry sectors: chemicals, consumer products, energy and natural resources, financial services, healthcare, industrial, media, retail, and technology. KKR has historically pooled money from various sources: institutional investors, pension funds, sovereign funds, high net worth individuals, private equity firms, and endowments. As one of the largest private equity firms, the company has had hand in several notable investments, including $45 billion bid for the Texas Energy Utility Company, a $33 billion transaction for Healthcare America, and a $31 billion deal for RJR Nabisco. In this presentation, we are focusing solely on the First Data Corporation LBO of $29 billion. Its competitors include various different types of private equity and LBO companies in this space. Although there are several private equity and LBO firms, the most notable ones are Capital Trust Inc., Prospect Capital Corporation, Affiliated Managers Group, Apollo Global Management, Conan Sears Inc., the Blackstone Group, and Oxidative Capital Management. These competitors specialize in a wide range of industries, such as media, entertainment, real estate, manufacturing, and chemicals. With billions of dollars under management, the aforementioned competitors selectively seek out transactions in companies of various sizes, build up growth capital, and find distressed assets to return for profit.
Regulatory, legal, tax, and accounting issues. Fortunately, there are no legal, tax, or regulatory issues. However, there were some accounting issues. Because of the massive amount of debt being taken on to finance a buyout, First Data's debt was downgraded to B+ by Fitch. Also, the group of banks that agreed to finance the agreement were worried about being able to sell the debt to investors. As a result, KKR was unable to get covenant agreements. KKR was forced to agree to minimum EBITDA requirements in order to offer some, but not much protection to the lending institutions and investors. Although these covenants are in place, they have been called by analysts as toothless. To prove there are no regulatory issues, this is the regulation approval document, and in Article number 3, we can see that after examination of the notification, the Commission has concluded that the notified operation falls within the scope of council regulation.
This segment will discuss the size, composition, and leverage ratios. KKR signed an agreement to acquire First Data Corp for $26.3 billion on April 1st, 2007. As mentioned previously, the deal would value the current shares of FDC at $34 per share in cash, a 26.4% increase from the previous day's closing price of $26.90. The agreement also included a $700 million sell-side termination fee. The graph here represents the impact on share price once rumors of a merger began to circulate. It also shows the total value placed on the total enterprise in relation to the company's earnings before interest and tax. The 2007 10K revealed a total purchase price of $26,585 million, not including transaction, restructuring, or other costs associated with the purchase. The chart gives a price breakdown for each segment of the company. You can see that goodwill, the difference between the purchase price and some of the fair value of the net assets, is what KKR paid the most for. Other fees would drive the total cost up significantly. Just one example would be the fees paid for advisory services. Other companies were paid as well. As you can see, Evercore Partners was paid $4.75 million, while Morgan Stanley was paid $45 million. Despite the $26.3 billion offer, these were the final transaction costs. The final net transaction was $27,710 million. The total cash and short-term investments added to were $924,500,000. This brought the total final gross transaction value to $28,634 million. The merger was financed by a combination of the following: borrowing under the company's senior secured credit facilities, senior unsecured term loan facility agreement, senior subordinated term loan facility, and the equity investment of holdings. The merger was funded primarily through a $7.2 billion equity contribution from holdings and a $22 billion in debt financing. The two main ratios we wanted to mention are the debt to equity and the debt to EBITDA. The debt to equity ratio is a financial ratio indicating the relative proportion of shareholders' equity and debt used to finance the company's assets. Closely related to leveraging, the ratio is also known for measuring risk, gearing, or leverage. You can see here at the end of 2006, the company's total debt to equity was 24.6%. The impact is as follows: in 2007, it increased to 327%, and in 2008, it was 939.6%. Debt to EBITDA is a common metric used by credit rating agencies to assess the probability of defaulting on issued debt. A high debt to EBITDA ratio suggests that a firm may not be able to service their debt in an appropriate manner and can result in a lower credit rating. As was noted earlier, this is why the debt of the company was downgraded.
These are the sources that we used when compiling our report. Most of them were online sources. Thank you for viewing our presentation.